All right, hello everyone and welcome to the second webinar in the Legal Food Hub's winter webinar series. Thanks so much for joining us today. I'm going to get started my name is Alex Schluntz. I'm the regional coordinator of the Legal Food Hub, and I'm going to get started by telling you a little bit more about the Legal Food Hub before I turn it over to our presenters to talk about today's topics of nonprofit entity governance. So the Legal Food Hub, I think, is best described as a matchmaking service. We're a nonprofit, a project of the Conservation Law Foundation, and we essentially match small farmers, low-income food entrepreneurs, and nonprofits that work within the food system to free legal services. We currently operate in Massachusetts, Maine, Connecticut, and Rhode Island, and we're able to help on a range of issues, such as real estate transactions, maybe a purchase and sale agreement or a lease. We can assist with entity formation, both for-profit and nonprofit organizations, and much more. So I'd encourage you to check out our website, legalfoodhub.org, and look at our services there. And you can also view some of our educational resources, and you'll be able to, after this webinar, view it link on our website as well. So now I'm going to turn it over to our presenters. Today we have June Han, who's a third-year student at Harvard Law School and a student advocate at the Transactional Law Clinic of Harvard Law School. She plans to practice corporate law in New York after graduation. We also have Noelle Roycroft, who's an attorney and clinical instructor with the Transactional Law Clinics of Harvard Law School. Before coming to Harvard, Noelle was an associate in the corporate department of Ropes & Gray, LLP. Noelle was also previously a fellow and associate counsel with the National Office of the Lawyers Committee for Civil Rights under Law. She holds a BA, a graduate certificate in nonprofit management, and a JD. So I'm going to turn it over to June and Noelle, who are our experts on this topic, and we can get started.
Thank you, Alex, for the introduction, and thank you everyone for joining this webinar. The topic I'm going to be presenting today is the governance of Massachusetts nonprofit organizations. So, as an introduction, note that today's presentation focuses on one of the most common forms of nonprofit organizations, the 501c3 tax-exempt nonprofits. And nonprofits, if tax-exempt, are regulated on both the state and federal level. So we'll be discussing requirements that come from both Massachusetts law and federal law. Most basically, the organization is required to have a board of directors that is responsible for the overall oversight of the organization. Nonprofit organizations may also have voting members who act like shareholders for-profit organizations who have the right to elect board members and vote on certain major transactions. And these major transactions may include changing the nonprofit organization's purpose or name, or sale or lease of property. Nonprofit organizations are not required to have members. Why might you think about having members? It perhaps demonstrates broad participation. The downsides of having members, however, is that it can make governance more complicated. Members have statutory rights under the Massachusetts nonprofit statute, and you also have to keep up with notifying and documenting member voting and meetings. The Articles of Organization is one of the formation documents, and it contains the basic governance provisions of the organization. It also includes the names and addresses of the nonprofit organization. You'll find the purpose of the organization also in the Articles of Organization. If you are tax exempt, organizations are also required to satisfy the IRS requirements for tax exempt purposes, in addition to the Massachusetts requirement. The Articles of Organization also include provisions for board of directors and officers who must include president, treasurer, and clerk, their names and addresses. It can also address whether organization will have members and the name and address of the registered agent. You will file the Articles of Organization with the Secretary of Commonwealth, so it is a public document. The other formation document that we'll be talking about is the bylaws, and the bylaws are the organization's operating manual. It provides the basic governance and operational structure of the organization, and the organization should check periodically whether the actual practices of the organization conform to the bylaws. They do not need to be filed with the Massachusetts Corporations Division with the Secretary of Commonwealth, unlike the Articles of Organization. Typical bylaws provisions may include the elections, composition, terms, removal, and duties of the organization's directors and officers, qualifications and functions of any members if your organization does have members, rules as to conduct of meetings, which includes notice, quorum, voting, or how the board generally functions, organization's committee structure if there are any committees. The bylaws may also include a conflict of interest and compensation provision, although one note is that conflict of interest policy can be a separate standalone policy, and bylaws will merely reference to that separate policy, but we will be addressing conflict of interest policies later in this presentation. And also, it may include provisions regarding indemnification or immunity. So it's important that the activities of the organization be in furtherance of the purposes set forth in the organization's application for a tax-exempt status and its articles of organization. So when organizations plan activities, they should carefully review what activities that they're planning to do and keep close track of where money goes to and comes from. And when planning to do something new or different, it is always a good idea to check with a lawyer first. An organization may conduct one or more unrelated businesses. There is nothing inherently wrong with an unrelated activity, but board members should know why the business is being conducted, be certain that this activity doesn't detract from other program undertakings, and be satisfied that the organization's exempt status is not being jeopardized by these other activities. So we're going to look in more depth about the duties of board of directors and officers. The board sets the policy for the organization and oversees its affairs, while the actual implementation of the plans and programs and the day-to-day management of the organization is left to the officers and employees. So to start with the board of directors, there were some categories that we wanted to touch upon. First is size. Tax-exempt organization must have at least one director. Size of the board is a state law matter, and Massachusetts does require a minimum of one director. But there has been some hints from federal agencies, such as the Senate Finance Committee or the Department of Treasury, and their sort of hint on the requirement for size is that there should be 3 unrelated individuals for IRS purposes. Directors can be elected either by other directors, we call this a self-perpetuated board, or if your organization have members, you can have an election by those members. As for term, typically board members will serve until the next annual meeting unless the articles of organization or bylaws specify other terms. Often the articles or bylaws provide that board members serve 2 or 3-year terms. And if so, the expiration of board terms is usually staggered so that only 1/2 or 1/3 of the board is up for election each year. And this ensures that there's continuity on the board. As for composition, the board typically consists of independent volunteer directors. The IRS requires nonprofit organizations to disclose the number of directors who are considered independent in accordance with their tests, and whether any directors have family or business relationships with officers, other directors, or key employees. Form 990 specifically inquires about the total number of directors and the number of independent directors who meet the definition in the IRS instruction. A director is considered to be independent if all of the 3 following circumstances applied at all times during the organization's tax year. And those 3 conditions are, first, the director was not compensated as an officer or employee of the organization or of a related organization. Second, the director received total compensation as an independent contractor from the organization of less than $10,000 for the year. Third, neither the director nor any family member was involved in a transaction, either with the organization or with a related organization, that was required to be reported on Schedule L, which is transactions with interested persons, and it is a schedule included in Form 990. So sort of in overall, the focus is on the compensation received by the director or his or her family member from the organization or related entity. The National Council for Nonprofits does advise that organizations should not compensate board members. And if board members are paid more than $600 per year, the nonprofit must issue them the IRS Form 1099. As for the officers, as mentioned, Massachusetts requires a president, treasurer, and a secretary, and all three positions can be held by the same person. The terms and responsibilities of these officers are set out in the bylaws of the organization. They're elected usually by the board or by members if the organization has members. And these are the people who are typically responsible for the day-to-day management of the organization and carrying out directions of the board. And directors can also serve as officers of the organization. So we're going to look further into the duties and responsibilities of the board of directors. And the material that I'm going to present from now on is both legal and advisory based on the guidance from the Attorney General's office. As mentioned, it is the board's job to oversee the organization and that the organization is faithfully carrying out its purpose. So the law imposes fiduciary duties on the board of directors, and there's two fiduciary duties, the duty of care and the duty of loyalty. So the duty of care is that the director must act with such care as an ordinarily prudent person would employ in your position. Duty of loyalty is that the director must act in good faith and in a manner that you reasonably believe is in the best interest of the organization. So as for duty of loyalty, a director must exercise power in the interest of the organization and not in their personal interest or interest of another entity, particularly one with which they have a formal relationship. So what does this look like in practice? Well, duty of care means directors attend board meetings and committee meetings. They prepare for board meetings. They review materials beforehand. They are prepared to ask questions. They also engage in periodic evaluation of the officer's performance. They review the finances of the organization and ensure that the organization complies with all the applicable federal, state, local laws. The Massachusetts Nonprofit Corporation Statute does permit directors to rely, under appropriate circumstances, on reports and recommendations from others. So a director may rely on information from an officer or an employee who the director reasonably believes to be reliable as to the matter presented. The directors may also rely on information from attorneys, accountants, or other professionals as to matters that the director believes are within such person's professional competence. And if there is a committee, information from committees of the board as to matters delegated to the committee, which the director reasonably believes merits confidence, those information the directors may also rely on. As for duty of loyalty, this means that the director disclose any conflicts of interest, they adhere to the organization's conflict of interest policy, which I mentioned earlier we'll be touching on later in this presentation. They avoid the use of corporate opportunities for individuals' personal gain. They also do not disclose confidential information concerning the organization. There is a caution to take with respect to private inurement. Federal tax exemption is conditioned upon the fact that no part of the net earnings of the organization may inure to the benefit of any private shareholder or individual. So when we dissect this definition, there's no strict definition for what it means to inure, but this is generally understood as providing unjust enrichment from the organization's earnings to another party. And when they say private shareholder or individual, the Treasury regulations defines those people as persons having a personal and private interest in the activities of the organization. In other words, they're referring to the insiders who are in position to influence or control the use of the organization's assets for personal gain, such as founders, directors, or officers. So in summary, nonprofit organizations cannot engage in private inurement. Organizations that violate private inurement fails to be operated exclusively for exempt purposes and is subject to revocation of its tax-exempt status. An example of what a private inurement may look like is a compensation agreement with an insider where there is no upper limit, or a compensation agreement that is based on factors that are unrelated to performance, or using the organization's earnings to provide goods and services to insiders, etc. a note on private inurement is that the organization should also not commingle funds or use company accounts for personal loans of its directors or officers. As mentioned, duty of loyalty is closely linked to conflict of interest. If a director has a conflict of interest, the director's compliance with his or her duty of loyalty will be vigorously scrutinized by courts. So a conflict of interest policy, which is our next slide, is very important to have. So conflict of interest refers to the potential conflict between a director's own financial interest and duty as a board member. Conflict of interest is not inherently illegal. The important factor is the process by which the board of directors copes with these conflicts. So when situations arise where a board member may potentially derive personal potential benefit from organization's activities, a conflict of interest policy helps protect an organization and its board members by establishing a procedure for disclosure and voting. The IRS asks the organization if you have a conflict of interest policy in place in the Form 1023. Conflict of interest policy, as mentioned earlier, can be in the bylaws or as a standalone policy that is referenced by the bylaws. And you can see samples of it in the IRS Form 1023, Appendix A. There's also some advice from the Massachusetts Attorney General's office. A conflict of interest policy can address the procedure for annual written disclosure by directors or officers of their business involvements and interests, a procedure for determining whether a conflict exists and how to deal with potential or actual conflicts, procedure for withdrawal from discussion and voting by directors with a conflict, and also may address conflicts that can be reasonably foreseen based on the organization's activities and the procedures for when there is a violation of the conflict of interest policy. The Attorney General's Form PC, which we will touch on later, also requires the value and terms of these related party transactions to be disclosed. So it may be advisable to obtain outside evaluation or appraisal of any major transaction that is being proposed between the organization and a director or any entity in which a director has interest. So from here on, the material is largely based on the Attorney General's Guide on Nonprofit Governance. The board is responsible for hiring and overseeing executive officers. The board needs to engage in the selection process to find the right person to carry out the organization's purpose efficiently and effectively. This may entail developing a written job description or a CEO profile that fits into the organization's mission and current needs prior to hiring. The organization may form a committee with majority board members, but they may also include staff members who are more knowledgeable about the organization and its mission. And if the size permits, the entire board should interview final candidates and contact references. And after the hire, the board is responsible to engage in periodic review and evaluation of the officer's performance. Another responsibility that relates to officers is to set executive compensation. There is scrutiny over the process and reasonableness of executive compensation by the Attorney General and the IRS. Any complaints of excessive compensation or private benefit can expose the organization to legal action and damage to reputation. So in practice, the board must be informed of what the executive compensation package is, including non-salary compensation. The board should consider the performance of its own CEO and senior managers and compensation received by other similarly situated executives in the field. If the organization is using a compensation committee, the compensation committee should not make the final decision. If the organization is using a compensation consultant, their recommendations also shouldn't carry full weight. It's the board members who should determine what is reasonable for their organization specifically. And whatever the process is, the organization must ensure thorough documentation. To carry out the legal responsibilities, the board member must also be able to make informed judgments about important matters that affect the organization. So in practice, the board has the right to reasonable access to the management, the principal advisors, which includes auditors or attorneys, and any internal information. As I said earlier, the law permits directors to reasonably rely on information from the organization's staff, lawyers, auditors, outside advisor, at the organization's expense for assistance in making those judgments. Another primary responsibility for the board is to make sure that the organization is financially accountable and is not allowing charitable assets to be used inappropriately or diverted to private interests. So there should be mechanisms in place to keep the organization fiscally sound and ensure that they're using restricted funds properly. So board should ensure that the organization develops a realistic annual budget and has adequate internal accounting systems and controls. And this budget should be developed early enough for the entire board to review and approve before beginning of the fiscal year. And also ensure that the restricted funds are being used in accordance with their terms. Other practices may entail seeking periodic confirmation from the management that all the filing requirements are being met. It could be prudent to consider independent audits or standing audit and finance committees, but even with a standing committee, the board should still receive or act on the report of an independent auditor, get and review periodic financial reports, and approve the budget. The charity's board should also be vigorous and responsive to the mission of the charity. This entails establishing a nominating process which invites openness, variety, and change, and ensuring that the board is vital and diverse. So this may entail the board identifying characteristics such as commitment, skill, experience, background, perspective, interest in the organization's missions, etc., that will serve the organization's current needs. The AG recommends working with a larger candidate pool if possible, and also to review current board members periodically to confirm their continuing interest in the organization's mission and their suitability to serve as directors. So we're going to move on to some of the filing requirements and maintenance that is required of nonprofit organizations. First, with the filing requirements. So to start with the state filing requirements, the first is the Massachusetts Secretary of Commonwealth annual report that must be filed by November 1st each year. There are some exceptions for churches, religious organizations, nonprofit schools, colleges, etc. These annual reports must be signed under penalties of perjury by an officer of the organization. The second state requirement is to file with the Massachusetts Attorney General's Office. There is a one-time registration with the Attorney General's Office's Division of Public Charities by sending a letter declaring existence, along with the copies of the organization's articles of organization, bylaws, and the IRS determination letter. There is also an annual filing requirement called the Form PC, which must be filed annually by all nonprofit charitable organizations, along with a copy of IRS Form 990 or 990EC for the organization's most recently completed fiscal year. If the organization revenues are over $200,000, there is some form of audit that you need to provide along with the Form PC. Now, organizations with gross support and revenue of $5,000 or less are no longer required to submit a federal Form 990 or 990EC with the Form PC. So in summary, organizations with more than $5,000 in gross support and revenue must file the annual Form PC with a Form 990 or 990EC. The Attorney General's Office does not accept the Form 990-N, but for organizations with gross support and revenue of less than $5,000, an annual Form PC will just do. Also note that it's illegal to solicit donations or funds until you have registered with the Attorney General's Division of Charities and obtained what's called a solicitation certificate, which is renewed yearly. And to get the certificate, you need to file the Form PC Schedules A1 and A2. The last state requirement is to file with the Massachusetts Department of Revenue and to register with them to be recognized as exempt from state taxes. And when you file with them, you would need the IRS determination letter. This exemption certificate is renewed every 10 years, And 1 month before it expires, the department may issue a new exemption certificate. Moving on to the federal requirements. So the organization must file an annual exempt organization tax returns, and depending on the organization's income, the form will differ. So the organization should file either the IRS Form 990-N, 990-EZ, or just Form 990. Small organizations with less than $50,000 in annual income must file at least the Form 990-N. The first tax return is due on the 15th day of the month that begins 5 months after the last day in your fiscal year. And this tax return must be filed by the due date, even if the organization hasn't yet received a letter from IRS recognizing the tax exempt status. So if the organization owns real and personal property, you can also file you can also file with the local town or city tax assessor the Massachusetts State Tax Form 3ABC, which is the return of property held for charitable and other purposes by March 1st of each fiscal year. If you fail to file Form 3ABC on time each year, there's no exemption from local property tax that can be granted, and previously exempt properties may also be taxed. And you can access this Form 3ABC from the mass.gov website. And when you file this form, you should also include a copy of the IRS determination letter. So moving on to corporate formalities. So it's important that nonprofits are separate legal entities. But if some problem arises where a director or an officer may be personally liable, observing corporate formalities can serve as a shield against that liability. So organizations should meet at least once a year for board meetings, but the best practice for IRS is to meet quarterly, so 4 times a year. And during these meetings, annual elections of officers and directors are usually held, annual budget is passed, operational and strategic decisions requiring votes are discussed, etc. And if an external document or record is discussed, such as a financial report or a committee report, they should become part of the meeting minutes as attachments. And retention of these meeting minutes is very important. IRS says they should be kept permanently. The meeting minutes records could include the date, time, and location of the meeting, whether a meeting is a special or a regular meeting, whether notice was given or a waiver of notice was signed by all directors, names of directors in attendance and not in attendance, guests, if any, whether a quorum was established, the board action that was taken during the meeting, and the summary of major argument. Record keeping is a fundamental corporate formality to observe. Records to thoroughly maintain include finances, which includes funding sources, how much money you received from each source, how much money was spent for each activity or program, etc. That is also best practices for organizations to open a bank account. Monthly statements from the bank can serve as a good way to double check and confirm the financial records internally. And as mentioned, the organization should not commingle personal funds with the organization's funds. Also, making payments with checks rather than cash can provide a better record-keeping system. It is an option for organizations to consider hiring an accountant to assist with financial record-keeping or with establishing a reporting and documentation system for the organization. Also, it's important for the organization to keep copies of any promotional or fundraising materials. These include newsletters, brochures, journals, or pamphlets. And whenever an organization sends out requests for donations or hosts a fundraising event, it should keep the copies of any materials it creates, such as the due statement, fundraising solicitations, tickets, receipts, etc. So thank you for listening in, and if you have any questions, we'd be happy to address them.
Thank you so much for that great presentation. If you have any questions, you can submit them now through the Q&A box, especially if they're kind of general questions about the material presented. I'd also encourage you, if you have specific questions relating to your organization, or you're interested in maybe additional legal advice, to reach out to the Legal Food Hub. We're happy to have a conversation with you about potentially connecting you to an attorney to assist. So again, we're at legalfoodhub.org. So we'll leave it open for a couple of minutes here and see if we have any questions come in. And then again, if you have any specific questions, to please reach out to legalfoodhub.org.
It looks like we have one on how much variation there is in state requirements in New England. So to be honest, I'm born in Massachusetts, so I'm not entirely aware of the state requirements across New England. I know that there is some variation in the solicitation certificate requirement. So this often comes up with nonprofits that are kind of multi-state nonprofits, and they practice in, both Massachusetts, and maybe they have programs in other states. So, you really, when you form a nonprofit, you file your articles of organization or incorporation in one state. And then, so for example, if you file in Massachusetts, you're a Massachusetts nonprofit. But if you're going to be practicing, to operate in other states or fundraising in other states, then you do have to check the laws of those states to see what are required. I would say, on average, like if you say you run summer camps or something like that, and you have a summer camp in Vermont, it's probably very likely that you're going to have to register as a foreign nonprofit there. And if you're doing like direct solicitation and fundraising in other states, you might have to get something similar to what Massachusetts has, a solicitation certificate there. That being said, I know that not every state in New England actually requires a solicitation certificate. Massachusetts is also pretty different from other states in that the Massachusetts Attorney General's office oversees public charities. In a lot of other states, it's really just the Secretary of State. So where that comes in Massachusetts is, you register with the Attorney General as a public charity, you get that solicitation certificate. It also comes in with if you want to dissolve a nonprofit. So we always caution people to be very sure that you want to form a nonprofit before you do, because in Massachusetts, it's difficult to dissolve them because you've basically received this benefit of not having to pay taxes for a while. So the dissolution process is typically that you have to go through the Attorney General's office, get approval, and then you also have to file some complaints with the Supreme Judicial Court and get it approved there. So it's not an easy process. If you have assets, you would have to transfer them to another similar charity or to the government. So that's a long answer to that question. But generally the state requirements are pretty similar, but the Mass AG's process, that is a wrinkle in Massachusetts.
And now we have another question. The question is for the meeting requirements for governance and corporate formalities is, can you have virtual or remote meetings by phone or web under Massachusetts and federal law if the board plans to vote on anything?
Yeah, so for the Massachusetts nonprofit statute allows you to do something called action by written consent. And if you do action by written consent, just know that any decision that is taken has to be unanimous. So that's different than an in-person meeting requirement where you could do it by a majority vote. And it's a little bit, for us, we've looked into this before, an open question on whether certain types of virtual meetings would be considered a meeting or would be considered action by a written consent. The way common law works around board requirements is really that any action that's taken by the board is taken by the board as a body and not by an individual. So, some of the first case law on this, it was boards trying to take action by like written letters to each other. And the court said that's not really, action by the board altogether. And so that's where this like written consent exception came in. And that's why it's been written into statute, just to make it easier for people. But that's why they have that unanimous requirement there. So, a bit of an open question. I think that you can definitely do it. I think maybe the safest way to do it though is, if you have an action that's going to be taken, make sure that it's approved by unanimous consent.
Great, thanks so much.
Mm-hmm.
Are there any other questions? Feel free to type them now. So it looks like we have another question. Who within a nonprofit board is responsible for creating policies around the topics that you discussed?
So the law doesn't impose a requirement on any one person in the board. So you could have, say, if you want a conflict of interest policy, you could direct your executive officer to retain an attorney to draft that for you. But any policies should be adopted and approved by the entire board. So, you would look at your bylaws to see how votes are taken. So if, a default in your bylaws, which is what it is in most, is majority vote, then you'd basically during your meeting of the board, you'd put forth a resolution and put forth a policy asking for adoption of the policy and then take a vote on it.
Great. And are there any specific structures within the board that are most commonly used, even if they're not mandated by law, regarding who's in charge of what policies or anything like that?
No, I can't think of any typical ones. So most of our clients are pretty small, so they don't usually have committee structures. A lot of people, when they first incorporate, it can be hard to find board members always. So we see a lot of just the minimum 3 board directors. So having committees is, not really necessary when you have such a small board. As you get larger, you might see committees break out. So you might see, like policies related to financials done at like an audit committee level or something like that. But in the end, they should all be approved by the entire board. And typically something like that, getting a policy drafted first, we would see that like delegated to an officer to go out and have that done. And obviously there would be discussions with the board and it would be presented to the board, but not usually required by a certain committee.
Great, thank you.
Yeah.
Any other questions out there? Great. Okay, here's one more. So given the rigorous requirements for a nonprofit in filing with the state and the federal government, are there best practices to be aware of for operating as an organization that isn't formally a nonprofit? So such as like before you file as a nonprofit, but you're planning to file as a nonprofit, is there anything you should be doing in that time period?
So I think I would be keeping good track of basically any funding so you are able to get, for example, like reimbursed for your formation costs. So that's a question that often comes up for people, that we're advising where they're just starting out and obviously they have expenditures to do that. And they're probably spending a lot of money. Will they ever, get reimbursed for that? And so you are able to do that. You would just have to show, records that the money really was spent for forming the nonprofit, and that everything's at fair market value. So you're not, making any money off of this. So I would say, best practice would be good record keeping at that point. Also, I think, this is just always really a red flag for me. We do have sometimes people just think, oh, well, it would be better just to form something, just so that I have some sort of like formal entity in place and the liability shield. And so they'll go out and form like an LLC or something like that. And it's very, very difficult to go from a for-profit to a nonprofit. So if you're not sure yet what you want to be, but you think you might want to be a nonprofit, I guess my advice would be don't incorporate as any sort of for-profit entity. I can't think of really anything. So some of these, what we talked about, even if you're operating as like an unincorporated nonprofit association, a lot of the state requirements, not necessarily the filing, but just, thinking about your conflicts of interest and that, you're acting in good care and loyalty towards your organization, I would say still, try to adhere with those.
Great, thanks so much. We have another question that came in. So one participant recently saw a company state that it was a low profit corporation. Come from?
Really interesting. That is not a technical legal term. There's no such thing as a low profit corporation. There are C corporations, which are your traditional corporations, that everybody thinks of. There's an S corporation, and so that refers to a section of the tax law that allows a corporation to be taxed as a pass-through entity, which is like a partnership or LLC. And then in Massachusetts, there are benefit corporations. There's also benefit corporations nationally, and that doesn't actually refer to a legal term. That refers to like a private kind of agency that certifies that you are, operating in the public good. I think those are called B Corps, sorry. But a benefit corporation in Massachusetts is still a for-profit corporation. But what it essentially does is you are allowed to, in addition to having a duty towards your shareholders to maximize profits, you're also allowed to have some sort of like public benefit purpose. The reason why, Massachusetts adopted a statute to allow this is that there's a remote chance that a shareholder could sue you if you have a purpose, other than just maximizing profits for shareholders. So if you form as a benefit corporation, you basically get covered to be able to both do this, public purpose and to still be a for-profit. So it's basically you just follow the normal laws of a corporation, but you are required to have some additional annual reporting to the Secretary of State to call yourself a benefit corporation. I always, whenever, clients ask if they should think about becoming a benefit corporation, I think the main benefit to it is that you get good publicity around it, but you can still do, good, and you could still maybe not have like an official public benefit purpose with a for-profit corporation, the traditional, but there's still a lot of movement there. So it's just a question of like how much additional regulation you want. But in terms of like a low profit corporation, that's not an actual legal entity that's recognized in the law.
Great, thanks. That's really helpful. Are there any more questions? If not, we might close out soon. Great. Well, thank you all so much for attending. And if you think of any questions later, feel free to reach out again to the Legal Food Hub at legalfoodhub.org. And we'd be happy to talk to you about finding an attorney to answer some questions that relate to your organization. Thank you so much to June and Noelle. This has been really excellent. Thanks for your expertise.
Absolutely.
Thanks, everyone. Bye.
All right. Bye.